If so, why? All right, we're going to kick off our A block by keeping a promise to you that we will let you know every time we see a trend story that really could affect your livelihood. It's what we do for you, right? Whether it's good or bad. If something doesn't make sense, but your politicians and the media that you are watching continue to tell you it's no big deal, forget about it, you know what? That's when you want to start asking questions. And that's what we're doing tonight. With the news that for the fifth straight day, the Fed is intervening in the business of banking. Again. This time it's called repo operations. Joining us now to try and break this down for us is Christy I. She's the co-host of Boom Bust, as you see here on RT America. All right, let's start by explaining to a lot of people who don't understand what actually is the repo market. What's the repo market?
The repo market is a $1 trillion market in which the banks loan money to each other, trillions of dollars every single night in overnight loans in order to maintain their reserve ratios. So essentially, it's a system based on trust. When banks loan to each other, they take a little bit of collateral, and then the next day they'll get back the entire principal plus a little bit of interest. The interest, for the most part, is maintained at a very low rate, somewhere along 1.5 to 2%. For the most part. However, when there's a spike like this, when something like this happens, that means that there's an anomaly in the market. There's risk in the market. There's uncertainty. Because when you don't trust your counterparty, when you don't think that they're solvent, then you charge a higher interest rate. You might charge 5%, 10%, 15%, because you don't think that they'll be able to pay it back.
So are you actually saying that this high spike up to 10%, if I'm charging you 10%, that means I don't trust you completely. Exactly. If you came to me and said, Rick, I need to borrow some money from you. So does this mean that some of these bigger banks are saying to some of these smaller to middle to medium banks, we don't think you're going to be around sometime in the near future?
This was a liquidity crunch. So the Fed came out and said that it's completely different than what happened in 2008. That's what happened in 2008 when none of the banks trusted each other, because there was this rumor flying around that a lot of banks were insolvent. So that's why none of the banks trusted each other. There was a complete freeze. Let
me stop you for just a minute, Christy. If you guys could, let's put that up. Let's put that that graph up real quick that shows what we're talking about. So explain to us. You see, there is, if you see something happening just before 2000 and again just before 2008, right? What is that?
So those were other two instances. Right before every single crisis that we've previously had, there was always a spike in this repo market, which showed that there was a crunch in liquidity. That liquidity tightened, credit tightened because there wasn't enough credit to go around, because institutions didn't trust each other, and there was a credit crunch. And the same thing happened here. And while the Fed doesn't quite know what happened to cause this credit crunch, all the banks suddenly freaked out, and therefore the Fed actually had to jump in and pump in, as he said, $75 billion in an overnight repurchasing in order to then soak up all of that funding.
But what you just showed us with that graphic is anomaly and then recession.
Exactly.
Anomaly and then recession. What you're telling us has been happening for the last 5 days is anomaly.
Yes.
Do we have a recession coming?
This has been a huge recession, and many people think that this was the fault of the Fed. The Fed should have known better, but no, the Fed actually over-tightened the market. They started tightening since last year all the way through December, actually until July, actually. They've over-tightened the market, so now the reserves at the bank are at near lows, and so at the same time, you have a huge inflows of government treasuries coming out, and therefore the banks need to soak up all the treasuries. So now they have a liquidity crunch. The banks don't have enough money to go around.
The classic argument that we're looking at here, that I think a lot of people who are watching this conversation that you and I are having right now is, do we want our government to interfere? Because that's essentially what they're doing, to try and save our economy, save us from a recession. Or do we want them to stay the hell away and let whatever happen, happen?
Well, I think the bigger question is, even if the Fed wanted to interfere, can they actually do anything about it? Because as we said, the Fed has been trying to lower rates for this entire past year. They said we want to lower rates, lower rates, lower rates. But in actuality, they actually lost control of the very rate they planned to manage. They wanted to lower rates. Instead, the rate just shot up to the moon all of a sudden, and they had no control over it. So that kind of shows how inefficient the Fed is, how broken this entire policy is. And so more importantly, one should ask themselves, how stable is this entire full economic debt load that actually actually rests on top of this benchmark rate.
I can't help but just think, from a total rudimentary standpoint, that if I know that my government is having to come in to, in essence, feed money into my bank, liquidity as you experts would call it, I should be concerned.
Absolutely, and $75 billion, that was only one day. In total, in the last 5 days, they pumped in $300 billion into the entire system. That's a third of $1 trillion into the system. That's a massive amount. The last time we had something that massive was during the Great Recession.
How's the global market going to react to something like this? Are they going to be a little shook about this situation here with our government, our Fed, once again, as we like to say, interfering?
I think that they're actually starting to take notice, because the Fed actually came out originally trying to placate the entire market, saying that, oh, this is just a one-time spike. This is temporary. This is a technical glitch. We made a mistake, but we can fix it. It should be done with and resolved within a week. However, the week is over. It's Monday. It's the start of a new week, and yet there has been no resolution. The entire problem is actually persisting throughout the entire market, and that's going to have ripple effects throughout the entire global economy. And so the Fed actually released their new schedule already, and their schedule shows that they expect the problem to now persist for a month.
Oh, my goodness.
Maybe even longer.
A month or longer?
A month, potentially even longer. They opened the door in order to continue operations for longer than a month now.
This could get very serious. I'm glad we have you, Christy. You're super smart, but you're able to make this plain so we can understand it, and we thank you for that.
Of course.
Christy I.